Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the calculation of book value per share, earnings per share, and PE ratio, price to earnings ratio. Get ready, because it's time to take a stance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we're in the 2, 3, 4 book value per share, earnings per share, PE ratio section under the practice problems tab. Closing this back up, we're going to have our information up top. Then we're going to work our problem down below. Once again, the problem is going to be first thinking about the balance sheet calculations, to look at our equity section, book value per share, earnings per share, price to earnings ratio, market value per share to book value per share. So here we go. Information up top. We've got the assets that are given, the current liabilities, long-term liabilities, preferred stock outstanding, shares of common stock issued. That's going to be the information that we will use, in essence, creating basically the accounting equation and then looking at these calculations. Then we have, if there is earnings available to common stockholders, price earnings ratio, PE ratio 23. So if there is earnings available to common stockholders of 31,900 and the price earnings ratio, PE ratio is 23, what is the price of stock? So we'll kind of back into the price of stock. And then C says market value per share to book value per share. We'll do a comparison of the market value and the book value. Okay, so remember that we're doing this book value calculation first. So we're basically going to be looking at the balance sheet, and we want to be looking at the equity section. Why? Because the balance sheet is where we stand as of a point in time. Balance sheet from an accounting standpoint is represented with the accounting equation assets equal liabilities plus equity. Assets representing what the company has. The other side of the coin being who as claim to those assets, liabilities, third parties, equity owner. Then from a finance perspective, we'll often be rewriting the accounting equation, subtracting liabilities from both sides of it to come up with assets minus liabilities equals equity. This giving us what the company has minus what they owe equals equity, which is basically the book value of the company. That would be the owner's claim to then the assets. Then we can break out that equity and think about it by who the owners are. With regards to corporations who are owned by stockholders, we could break it out by those standard units of ownership, the stock. So let's do that. We're going to do the balance sheet first. Thinking about the accounting equation, the balance sheet is in essence the accounting equation. So we've got the assets, which they just gave us at the $389,000. Then we have the liabilities, which they said they gave us components of the liabilities, the $75,000 and the long-term liabilities as the $95,000. If we add those up, then we have liabilities of the $171,000. Then we can take the assets minus the liabilities to figure out the equity, which is going to be the $218,000. And so notice that's just another way of us working basically the accounting equation. So we've got the assets $389,000 minus the $171,000 gives us the equity of the $218,000. Then if we see liabilities and equity, of course, meaning these two numbers, the $171,000 plus the equity of $218,000, that's got to be the liabilities and equity. So liabilities and equity equal assets because, of course, we figured what the equity needs to be by subtracting out the assets minus the liabilities. So that's going to be kind of like total equity. That's basically kind of like our accounting equation. I'm calling it the balance sheet. You know, this isn't a full extended balance sheet. We're calculating the accounting equation using kind of a balance sheet format here. Then we can calculate the book value per share. So we're going to say, all right, now we're going to say the book value per share. We're going to take the equity in the balance sheet that we calculated last time, and we're going to subtract out any preferred stock outstanding because the preferred stock, we don't think of them as kind of the owners because they don't have the purchasing power. However, they get paid first. Therefore, if we were to say liquidate the company, sell the company, pay off the shareholders, we would have to pay them first. So we need to subtract out the preferred stock outstanding to get to the amount that would be assigned to the common shareholders. And then we can take that and divide out the number of shares, 20,000 shares, not representing 20,000 owners, but shares, kind of like $20,000, you know, as unit of measure of standard value within the company, all the same valuations within the company. And so if we take that 179,200 that we can allocate to them, to the 20,000 shares, we come up with 896. Now notice that doesn't have to be even per se. The 179,200 divided by the 20,000 happens to come out to dollars and pennies right here, but doesn't have to. So just be aware that you could have rounding involved. Always could have rounding. So now let's consider the earnings per share. Earnings per share is different here because this is the book value per share, where we're saying this is where we stand on a per stock basis. Now the earnings per share, we're thinking about the activity, the income statement type of accounts performance. So what are the earnings per share? How well have we done over time on a per share basis? So then we're going to take the earnings available to the common stockholders, basically the net income amount, the income statement amount minus anything that would be owed to the preferred stockholders because they get paid first once again. And then we're going to take divided by the shares of common stock outstanding, once again the 20,000. We've seen this calculation in the past. That's going to be the earnings per share of 1.6. Once again, there could be rounding involved in it, right? So if I take the 31.9 divided by the 20,000, we've got, it's rounded, right, to 1.6. It's really 1.595. Okay, so this is where we kind of stand on a book value per share basis. This is how much is being earned based on, prior year numbers on earnings per share. This is performance number. This is basically where we stand. This is kind of like the bank. If you're thinking about a person, an individual, this is like kind of what's in the bank, right? And this is like, how much we expect to earn, our income. So then we're going to go down here, price to earnings ratio. So the price to earnings ratio is the PE ratio. It sounds just like it sounds. Now, what they gave us, they didn't give us the price. What they gave us are the other items within the formula, which is the earnings per share and the PE ratio. They gave us these two numbers. That's why the yellow number here is highlighted. So if they do that, because normally we would know the price and we would know that, and then we'd calculate the earnings per share and we'd figure out the PE ratio. In some cases, we might have to back into the price, but usually that's like a book problem type of thing to do to make sure that we understand these relationships. When you have to back into something, it's good practice to do so, because oftentimes we start to think, well, I need to recalculate the equation somehow. I need to figure out the equation to calculate stock in like an algebraic equation, as if I need to memorize another equation. You don't need to memorize another equation. You need to write it down just like you would for the PE ratio, with this as the unknown, and then you can think about it algebraically. In other words, I'm not going to try to think of an equation with the ending number being the stock price. I'm going to think of the PE ratio, stock price divided by the earnings, is going to give us the PE. I'm going to plug in the numbers that I know. Then if I need to write it down algebraically, I'll write it down algebraically. Notice I like to write it down vertically oftentimes first, because many calculations, especially in accounting, we memorize vertically. We memorize from a financial statement kind of standpoint. And then write it down algebraically if you need to back into something so that you can do the algebra more easily. This then being broken down algebraically as X, being the yellow number, divided by the 160 equals the 23. And then you can solve for X by multiplying each side times the 1.6, which is going to be the 23 times the 1.6. And that'll give us our 36.8. And remember, the reason it's slightly different is because it's not really 0.6. We said it was, what did we say it was? Let me check it out again. It was really 31.9 divided by 20,000 was 151. So, 1.595. So 1.595 times the 23, that's going to give us our 3669 about. So notice we have to deal with rounding when we deal with these items in a practice problem. You got to make sure that you round exactly where they want you to round, so you come up with the exact number. In practice, of course, then you're talking about decision-making processes, and these are none of these are perfect numbers. We want to have enough accuracy within them to make good decisions with them. So then we got the market value per share to book value per share. So now we're going to take the stock price. This is the price of the stock, how much it's selling for. Remember that the stock price is not something internal to the company. It's being determined by the market. It's being determined by actual transactions that are taking place trading the stock. If it's a corporate stock, stocks will be traded on the stock exchange, and therefore we will have a market. Because the units are all the same, then we can know what the price is by what it is being traded for. So that's outside the company. That's being determined. Then we have the book value per share is the $8.96 that we determined before. And so if we take the market value per share to the book value per share, we're going to say, all right, the 36.69 divided by the 8.96 is about 4.09, meaning the book value per share can be divided into the stock price 4.09 times. So notice these are all kind of ratios that we're going to use to try to get a picture of the valuation of the company. No one ratio is going to do it for us, because it depends on what we're looking for, and we got to look at it basically in different angles. So in this case, we're looking at the stock price, what it's actually selling for. This is how much we would have to pay in essence if we were an investor and we're buying another share. And the book value per share represents basically, as we saw before, the equity section, the value, assets minus liabilities, divided by the number of shares. And you might say, well, why would the book value per share then, assets minus liabilities on a per share basis, be so much lower than the stock price per share? And it could be because there's something that's not included in basically the balance sheet, and that's going to be the earning potential. Like, there could be something that's not being totally included in there, including something like goodwill, intangible assets that aren't reflected on the balance sheet, that reflect earning potential over and above what the book value would be, that would be represented on the balance sheet. So again, so note that when we make decisions about the future or some investment opportunity or something like that, we need to look at basically different ratios, looking at things from different angles. And then once we look at the different ratios, we get a better understanding. We start to put together a picture that will be a more accurate picture on which we can make decisions.